Have you ever wondered what it is really like to invest in real estate? Well, we're here to break them down for you. In this episode, we'll reveal the reality of real estate investing and shed light on some commonly overlooked risks that could make or break your investment journey. Real estate has remained one of the preferred investment assets among Americans for many years, with as many as 34% of people voting for it to be the best long-term investment in 2023. That makes real estate the leading long-term investment preferred by 44% of Americans, followed by gold, 26%, stocks and mutual funds, 18%, savings account and certificates of deposits, 13%, and bonds at 7%. If you feel ready, then take notes on the topic to make the most progress. Like any form of investment, real estate investment involves risk and property owners may lose money. If you are planning to invest in real estate and own an investment property, it would be wise to look out for the following 7 real estate investment risks. The first one being an unpredictable real estate market. Many investors wrongly believe that the real estate market could only move in one direction before the 2008 Great Recession, up, assuring him that his parents and siblings were safe in the next room with ropes tied around their necks. The basic principle was justifiably based on the idea of transmitting property today and selling it at a much higher price in the future. As for the property values, they indeed increase over time, but the market is quite volatile in this case, and your investment may plummet. Real estate, similar to prices, include aspects such as housing, rent, trends, supply and demand, the state of the economy, demography, interest rates, government involvement, and policies, not to mention any factors that are considered unforeseeable. You only increase your chances of losing out on investments that are on the wrong side of the trends in this way, by conducting intense analysis and keeping a close eye on your actual properties. Another risk is choosing a bad location. The key rule for buyers of investment properties is always to focus first on the location. A house cannot be relocated into a better area, and a retail building cannot be relocated out of a declining strip mall. Location ultimately drives the factors that determine your ability to make a profit. Availability and requirements for renting places, what sorts of properties are the most requested, the pool of tenants, rent level, and the possibility of property value growth. The best location is usually the one that offers the highest ROI, but one needs to spend some time identifying the best location. Another risk is negative cash flows. Net operating income shows the real cash that remains to be generated by a real estate investment after all the cash goes out for repairs, taxes, insurance, and mortgage interest. Anytime you get a report showing that money going in is less than that of going out, then it means that you are in a negative cash flow position. Some common reasons for negative cash flows include large vacancies, expensive building upkeep, expensive financing on loans, setting up for low rent, and failure to use the best renting tactics. It should be noted that negative cash flows are a potential problem that can be controlled, especially when one does their research well before investing. Invest some time into making realistic estimates of the income you hope to receive and estimate the costs that can be expected. Don't hesitate to do some research to ensure that the location is suitable. Another risk is high vacancy rates. Whether you own a residential single-family home or oversee a commercial building, it is critical to have someone occupy those units in order to receive rent. However, one of the biggest pitfalls associated with real estate investing is the inability to avoid a high vacancy rate. These vacancies are particularly dangerous if the revenue generated from rent is meant to cater for expenses such as mortgage, insurance, taxes, and repairs of the house. The only way to minimize luck in high vacancies is to purchase the investment asset that has high rental demand and is situated in a good area. You can also lower your vacancy risk if you set your rental prices with reference to the average market price of properties in that area. Advertise your property and promote its availability for rent, and ensure that your target tenant is aware of the property in case they need a place to rent. Move immediately out there in search of new tenants as soon as the current tenant gives you a notice that they want to move out. Make sure the house is clean and well maintained at all times. Another risk is problem tenants. You want to keep your investment properties filled with tenants to avoid vacancy risk, but that can also create another risk: neighbors, disturbances, vandalism, noise, and other forms of nuisance that can make tenants problematic. A bad choice may turn out to be the opposite of having no tenant at all, as the person is just a liability. Common problems with tenants include those who fail to pay rent on time or not at all, thus causing a long and expensive process to evict them and recover their dues, destroying the property, delaying reporting any damages, having more occupants in the apartment, whether human or pets, and neglecting all of their tenancy obligations. One can avoid such situations by ensuring that the process of selecting tenants is conducted in a very effective manner. Make sure that you perform reference checks and check for criminal records among all the applicants. When calling the referrals, ensure that you inquire about any instances of missed payments, damage to landlord's property, and any evictions that the applicant might have faced. You will also need to learn about the subject's work experience when preparing a tenant's background report. Ensure that they receive regular wages or stipends that can be used to afford necessities, be it house rent as well as other expenses. Nevertheless, it is advisable to pay ill-advised attention when a candidate has a scattered work history. An employee is likely to frequently change place of work. An applicant who changes jobs often may not be in a position to pay the rent and might have to move within the middle of a lease period. Another risk is hidden structural problems. When investing, one is guaranteed to make a loss if he fails to factor in the cost of repairs and maintenance necessary for the property. Depending on the severity of the problem, it may cost up to $100,000 to fix a faulty foundation, and more than $10,000 to repair or replace a central air conditioning or heating system that would degrade over time and last for around 15 years. Fortunately, it is possible to minimize this risk if you conduct a proper assessment of the property in question before purchasing it. Do not compromise on finding a competent and reliable property inspector, contractor, mold inspector, and pest control specialist to quiz a property and see areas that require a fixer-upper. Ask how much it would cost to fix if a defect is found, and either factor that cost into your price or pass on the deal if it would be unprofitable to do otherwise. The next risk is lack of liquidity. It is rather simple to sell stocks if one wishes to get some money or simply to turn to cash, but that's not how it works with respects to real estate. You can sell at a loss or below that of the market price because the lack of liquidity means that you'll have to sell your properties in a hurry. Remember, the typical buyer of a property usually makes the real estate commissions that are incurred in the sale of the property. These commissions can really pile up. You can easily adjust the price at which you're offering your property to meet them, but you should consider that when selling if you need cash urgently. But do not worry, because there's always a way to take out some cash if you need it from your property. Residential rental properties may be used to take a home equity loan or a home equity line of credit, do a cash out refinance, or take a commercial equity loan or line of credit for income generating properties. However, it becomes useful to calculate your possibilities before the worst case comes knocking at your door. So, are you ready to master your money? Like this video and subscribe for weekly insights. Have you ever thought about whether it's possible to invest in real estate without having to deal with the difficulties of property management? Investing in real estate stocks is similar to the excitement you felt when you purchased your first house. Private mortgage insurance is a requirement that safeguards the lender and may be familiar to you if you ever bought a home with a down payment of less than 20%. This is your opportunity to get into real estate investing and own a portion of the rental property market without having to deal with the headache of managing new commercial or real estate ventures or obtaining private mortgage insurance. Real estate investment funds, or REITs, are a popular choice for real estate investors because they enable them to purchase shares and rental properties on the same stock market terms as any other company. Numerous investors favor this method of investing in rental properties, but do take note, this isn't the monopoly game. Property investors are vulnerable to changes in the economy because market dynamics are a significant factor in real estate investing. The vulnerability is further increased by the leverage they use and the related expenses, such as private mortgage insurance for certain home buyers. Because of their regular income streams and advantages in diversification, real estate investment funds like REITs are profitable for many investors even with associated risk. This makes investing in real estate, especially investment property, a wise choice for a lot of people. The truth is that if investing in real estate was that easy, then everyone would be investing in real estate. Luckily, most of the problems faced by investors can be prevented through research and consultations before joining any contract. If you found this episode helpful, make sure to give it a thumbs up and subscribe for more tips and advice on smart investing. If you're investing in cryptocurrency, then you should know why Bitcoin investments will ruin your finances. Find out more in this video right here.